You've heard plenty about indicators like the ISM Index and durable goods, but do you really understand them? Can they really be used by investors to get an edge? Well, you'll find out more today. Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something. And together, we want to make the best investments that we can, so thank you for joining us. Remember, our goal here is to help you learn to invest financially and in all of life. You can always find more at investorinthefamily.com and subscribe to the podcast at iTunes, Stitcher, and the Google Play Store. And as always, if you would like detailed show notes from today's show, simply text the word family notes, one word, family notes, to the number 44222, or visit investorinthefamily.com and sign up, and we'll be sure to send you an email and get you taken care of. Do you like shopping for insurance? Of course you don't. It can be a terrible experience, especially when it comes to life insurance. If you have loved ones that you want to take care of financially after you're gone, then you may want to consider term life insurance, and Policy Genius is the easiest way to get insurance, period. At Policy Genius, you can figure out what you need, compare the top policies, get covered, and save. If you want to save on term life insurance, go to investorinthefamily.com/policygenius. That's investorinthefamily.com/policygenius for access created specifically for Investor in the Family listeners. I do get a small commission if you use my link, which costs you nothing. It's a win-win. Visit investorinthefamily.com/policygenius for more info and have the most enjoyable insurance shopping experience you've ever had. And hope you enjoyed today's interview with Leo Nelissen. Well, hey, Leo, welcome to the show.
Thanks for having me, Brian.
Well, it's an honor to have you with us, and I'd love to get started. If there's anyone listening already, will be able to tell you have you speak great English, but don't have an English accent. Could you tell us a little bit about where you're from and why you're speaking into the U.S. markets?
That's a really interesting question, to be honest. Well, I was born in Germany in 1995, so I'm 21 right now. And I moved to the Netherlands in about 16 years ago because my dad is Dutch. And long story short, why am I interested in the US market? Mainly because I'm fascinated by the US. Everything about the US fascinates me. People, culture, everything, to be quite honest. And I started to get into US stocks a few years ago to trade, the energy market, because the US, they have way more stocks, a way better selection than we have in Europe, to be honest. And from that point on, it really started. And really important to say, maybe the US has better investment tools, in my opinion. There are so many sites online, tools, also companies who do research that provide everything in English, and also, of course, focus on US stocks. So that's why I started focusing mainly on US stocks and US economy, because it's interesting, the selection is big, and the economy is far more important than, for example, the Dutch economy. Maybe German economy is also important. That's why sometimes write articles about Germany, but overall it's just the US that's more important and appealing to investors.
Sure. No, that makes a lot of sense. And you've written a number of articles recently that piqued my interest, and that's why we're, obviously here on the show. And, you've been doing a series of articles talking about your outlook on the S&P 500. Mm-hmm. You've talked about durable good orders. You've talked about the ISM Manufacturing Index. And those are all things I think would be really fun to talk about. And so of course, it could also be really enjoyable to hear your perspectives on some of the things going on in Germany. Well, just from the ECB in Germany and all of Europe, then even last week with Deutsche Bank and stuff. But lots of fascinating stuff. But we'll focus here in the beginning. If we have time, we'll talk about other things or maybe another time. But let's start by digging into your current outlook. And again, this is early October 2016 on the S&P 500.
That's a really good question. I thought about it a lot. Recently I published an article where I mentioned that I don't see much upside potential. And of course, there's always some upside potential. Markets can go up, and everyone is like, "Oh, why did the market go up today? We had bad economic indicators. We had heavy selling. We had somewhere in the world something happened and stuff." But what I really mean is that the odds of a successful long position for a few months is is really bad at the moment, mainly because we see growth slowing. I always mention growth slowing, which started in the third quarter of 2014. And from that point on, we saw that the market didn't go anywhere. I think the market peaked around early 2015. And the only thing long-term investors got from that point on was a ton of volatility, to the upside, to the downside. And that's really dangerous place to be as when I say uneducated, but as an investor in general, because you are waiting for breakout or breakdown, but neither happens. And what I try to do is, my S&P 500 Outlook articles are really about what can we expect in the next week or couple of weeks. For example, today we saw that the ISM index came in at 51.5, which means that the S&P is fairly valued at the current price. Even if you look like 12 months ahead, if growth, and by growth I mean ISM index and coincidence indicators, if growth stays at these levels, then we cannot expect a big market rally, because this is priced in after the recent S&P 500 breakout.
Yeah. Okay. So, let's talk about that for a minute then. So you mentioned the ISM Manufacturing Index. Can you talk to us about what that is and why it matters in terms of outlook on the S&P?
Yeah. The ISM Index is what I call, and what people call, a leading indicator, which means that it tells us what the market is going to do and what we can expect in terms of economic growth. So the ISM Index is a survey. I don't know exactly how many companies they ask, but they do a survey in almost every industry, and then they ask, what do you think in terms of outlook? What do you expect from the economy? And these companies, they answer the survey, and the Institute of Supply Management, the ISM, they code these interviews and they make an index like you could see today. And what this index tells us is what companies think is about to happen. So it is leading, as the word says. And when you then look at coincidence indicators, for example, industrial production, retail sales, durable goods, consumption spending, etc., we see that they follow the ISM index really closely. For example, I think it was in January or February when the ISM index bottomed, we could see that retail sales, industrial production, they all went up. At least if you look at year-on-year growth rates. And when ISM went down again, you could see retail sales going down again and industrial production. So it really tells you what is going to happen. For example, if you follow the ISM index, then you get a better view on these indicators.
Right.
People tend to be overwhelmed by, okay, industrial production was really bad, or retail sales were really bad, but it doesn't really matter, because the ISM index for the next month can already be up again. So people tend to focus on these indicators too much. You only need them, and I think that's really important to mention.
So on the ISM.
Yeah.
A couple things. You mentioned how retail sales and industrial production tends to follow it really well. Are there many cases historically where there's been a significant divergence between those two, where ISM went one way and retail sales or industrial production went a different direction that kind of throw that off, or is it almost always following in step with each other?
I don't have the chart in front of me, but I can tell you that they almost always follow the main trends.
Okay.
So if ISM index shows growth accelerating, you can expect retail sales, industrial production to pick up too. But what you can see is that in retail sales are lagging a bit more, maybe because the consumer in the US is a bit stronger, and that's also currently the case. You could see when growth slowing. Then again, when it started in 2014, you could see that cyclicals peaked. And by cyclicals, I mean industrial production, let's say mainly industrial companies and energy companies. in 2015, you saw that the general economy started to peak. Gap earnings started to decline, and even indicators, even industries that are not dependent on energy. And and now probably we are looking at a retail consumer peak. So that's another part of growth. So, and I think it really shows us why we're not going anywhere at the moment.
Right.
We're not going up or down in terms of growth.
Well, and one thing, one more question back with the ISM. You said, I think you said it's around 52 or so right now. What's
51.
considered, and 50, okay, so if I'm remembering correctly, anything over 50 is considered growing economy, anything below 50 is contracting. Is that correct?
Yeah, thanks for saying it, because I completely forgot it. Yeah, 50 is this magical level where you can say, if it goes below 50, you're talking about contraction. If it's above 50, you're talking about growth. In terms of recession, if the ISM goes below 40, then chances of a recession are extremely. There's almost no going back without a recession. You also have people who are really long-term investors who say ISM index between 55 or even 60 and 45 doesn't matter. They only want to know when growth is really hot or really low. But I can tell traders, look at this ISM index and then compare it to the ISM index in terms of year-on-year performance. I almost use this graph in every S&P 500 article because it really shows how high the correlation between the S&P 500 return and the ISM index is. It's really significant. And that shows once again that the ISM index is leading. And people should, I almost feel silly using the ISM index in every single article, but it's proven to work. People should use it. And overall, the people who I coach who do this online course we have on our site, people tend to follow this index and they are successfully doing it, even in terms of building a watch list. What kinds of trades do I want and how am I going to execute these trades, in terms of long stock A versus short stock B. All this information comes from the ISM index because the ISM index tells you way more than just what people expect about the general economy or manufacturing. They also tell you how good certain industries are doing. For example, this month you could see that furniture was doing quite well. And when you put this into a graph, with historical data, you really get a better picture of how a certain industry is doing. And that gives you a leading view on certain industries. So that's what I'm doing 90% of the time. Just looking what can I expect from certain industries, how am I going to trade these industries, and that's it. Really, it sounds really easy. It isn't that complicated, but it's proven, and it even works in times of slow growth, because one thing always works, and that's a secular trends. Like furniture is doing quite well versus metals. It's quite bad, like AK Steel, for example. But I'm going to write an article about this. But I tell every trader, look at these industries, look at the ISM index, and then you know what to expect. Different other things don't really matter.
Okay, and so I guess there's one big general ISM indicator, but they also have ISM indicators for individual sectors as well.
Yeah.
Okay.
Yeah. What they do. I can't go into too much that because we are offering this course, and I would
that's fine.
So too much. But what I can say, and it really gives people value, is go to the ISM website, search for these monthly reports, and then read the first sentences because they tell you everything. They make it so easy for you. For example, I have one here. This is the most recent ISM index. Wait 1 second. Here. This is what they tell you. Of the 18 manufacturing industries, 7 are reporting growth in September in the following order. And then they start listing these industries. So they do all the work for you. The only thing you need to do is analyzing this data, put it into your charts, and really learning how to work with it. That's also a main part.
So you use the ISM a lot specifically for like short-term trading, like weeks and maybe a month or so at a time.
Yeah, most of my trades are up to 3-4 months. Okay. Sometimes a week or two or 1 week, but overall I keep my trades a few months.
How long do you, in your experience, of a time frame, is the ISM helpful for? For example, I guess when they're doing their surveys and they're asking companies about their expectations, is it always they're asking expectations over the next month? Is it just okay? Yeah. So basically, ISM beyond 1 month time frame is probably not super valuable.
No.
Okay.
You can say one thing. ISM tends to lead the economy over one. You can say different. ISM tells you what is going to happen over the next quarter, 1 to 3 months. And of course, then we are not talking about the latest ISM print, but of course also the latest ISM print. But in general, what is the ISM doing? How is the trend? Is it weakening? Is it accelerating? And that really tells you what the economy is doing in the next quarter. And
sorry, go ahead.
Oh, no, go ahead.
You also mentioned durable goods is another indicator you like to talk about. Could you help us understand what that is and why it matters?
Yeah, durable goods are, of course, goods that are durable and are not consumed very fast, like, cars. Most people, I don't know how long in the US, but they have cars for like 8 to 10 years. But these products, these goods tell you a lot about how the US consumer is doing. So cars and computers, these are products that you don't buy every week. So these are really products that you're thinking about getting. You're going online, searching for test results, which model should I buy? And these goods tell you how is the consumer doing and also how a company is doing who produce these goods. Because, for example, durable goods, heavy duty trucks is something I really like to look at, because heavy duty trucks tell you, of course, a lot about the general economy. And you have heavy duty trucks when it comes to industrial production. There you get, they either deny the durable goods report or confirm it, because you get once how many orders are coming in, and then second how much is really produced. And this gives you, of course, a good outlook for Cummins CMI ticker, because they produce these engines for heavy duty trucks. And then, of course, good that I mentioned it, because ISM and Cummins are extremely high correlated, since Cummins produces these heavy duty engines. They are one of the most cyclical industries probably on the market. And what you can see is that the stock market return of Cummins Incorporated is extremely high correlated to the market. And really interesting to note is that heavy duty trucks have really imploded in the last couple of months. I think we are down 20% year on year, which means that they are doing absolutely terrible. But the funny thing is that the ISM Index rebounded since then, which means that the stock of Cummins went up too. And so many people that I know shorted Cummins because they saw these industrial production and durable goods numbers. But the ISM Index was up again, which meant that the next, heavy duty truck sales, industrial goods, etc., would be better too. So that's why Cummins didn't go down that much. So that's also, again, why leading indicators are so important.
So durable goods, is that also a leading indicator or lagging?
No, it's a coincidence indicator.
Okay. And so tell me...
The only lagging indicator that we have, I would say, is GDP. Overall, I can say the GDP trend could be interesting. I'm thinking about writing an article about it. But overall, GDP doesn't matter. Nobody really cares about it in terms of trading. Not one serious trader positions himself after a GDP number release, because It just doesn't tell you anything about what is going to happen. GDP tells you, that's another argument. Leading tells you what is going to happen. Coincidence indicators like industrial production, durable goods tell you what is currently happening. And then GDP tells you what has happened in the last quarter. So people, I always think or say that a GDP number release is really only good for brokers, because brokers earn so much when retail traders go nuts on the day trading accounts after GDP release.
One more question about durable goods.
Yeah.
How is that reported? So ISM, we mentioned the scale of how that's reported a little bit. How does that work for durable goods? What's the scale, and how do you know what's good and bad?
Durable goods are just like industrial production, retail sales in dollar terms. How much? Billions of dollars.
Gotcha.
But I never look at billions of dollars, because it simply doesn't matter. The only thing that's really important is year-on-year growth. The year-on-year growth shows you trends. It shows you really how the economy is doing. Some people also tend to look at month-on-month growth, but that's another one that's way too volatile, and you cannot spot any significant trends. It's really way too much noise. I always say the only thing that matters in general is the year-on-year performance of these indicators, because then you can see trends, etc. And that's why I think almost 100% of my graphs, except ISM and sentiment indicators, are year-on-year performance. So I think people should always go for the year-on-year change.
So when you're looking at your S&P 500 outlook over the next few months, it's either flat or negative, and largely you're basing a lot of that based upon slow growth we've seen since 2014, the market peaking in early 2015, all the volatility with no breakout or breakdown, but also based upon what you're seeing from the ISM Index as well as durable goods. Before we wrap things up, does anything else stand out to you right now that we should be aware of?
Good question. I think we discussed in terms of market outlook. I think we mentioned the most important things, and also I think when it comes to where to look for people. And I don't know if it's interesting for this chat, but for this interview, but people should stop day trading. I think that's a different topic. But what I see, I educate people. I have a few clients who I help, and almost everyone I ever helped started day trading, and they also had like mentors who taught them how day trading works. But every one of them failed. You have this 1999 rule. 90% of day traders lose 90% of their money within 90 days. And I think that's extremely accurate. I have done day trading a few months just to try it, and I can tell you it really doesn't work if you just look at these technical indicators. And that's another point. So I don't know if people listening who are day traders, but I don't know, look at your performance. If you are doing great, I mean, that's possible. 10% of day traders are doing great. But if you are the majority, you might really you might really want to change systems, because I really like to see people trying the midterm, professional way, in a certain way, because these people have less stress. They know these indicators. It doesn't change daily. I don't need to change my outlook every day.
Right.
And you can place your trades and keep them for a few months. It's really trading with a really low stress level. And I really like to speak to these people who have done it for a few months or years now. And they say, yeah, I'm really happy at the moment. It just works. Some of them are up, double digits this year. Some of them are doing a little bit, they're not so good, 1 or 2% up this year. But overall, these people start making money, and they really get what this market is about. What is influencing the market, which indicators. Because when I started, I think about 6 years ago, I was on Twitter and I followed Bloomberg, CNBC, etc. And then they had a new indicator like PMI, which is the Purchasing Managers Index, ISM, came in at 51, and was like, oh, that's great because it's above 50, so economy must be doing fine. And then next day, that industrial production was down 0.5% on a month basis. And then you were like, oh, gee, so the economy is not doing so great. But it's really about which indicators are important. How do I interpret these indicators, and how do I implement my trades? That's everything investors need to know. And then I think you can, it sounds a little bit cocky, but I think you can survive in every market environment if you're aware of what is moving stocks and which trade one has to place.
Awesome. No, that's helpful feedback. And I'm always appreciative of people willing to give some appropriate warnings and cautions to our audience as well. We definitely have to focus more on longer term type stuff. So that's well received here. And again, we want everyone to be able to find success in their investing. We realize there's lots of different approaches, but again, the caution is well heard and received. And Leo, thanks so much for coming on the show today and giving us some background on your current outlook, but even more importantly, why, because we love learning about how and why people invest. And I think you've done a great job of helping us do that today. So thanks for coming on the show.
Thank you for having me, Brian. I'm glad I could help your audience. And if people are interested in what I do, just send me a message on Seeking Alpha, Twitter, send me an email. Everything is possible. I'm always glad to answer questions.
Awesome. Thank you so much, Leo.
Thanks, Brian.
Hope you enjoyed today's interview with Leo Nelissen. Remember, you can get show notes with links and other details at investinthefamily.com. And you can subscribe to the podcast at iTunes, Stitcher, and the Google Play Store. And if you want one of my detailed summary sheet highlights, my detailed notes from today's show, simply text the word family notes, one word family notes, the number 44222, or visit investinthefamily.com and sign up. And we will be sure to get you taken care of. This is Brian, and thanks for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.